U.S. economic indicators are increasingly painting two different stories about the state of the American marketplace since the COVID recession. There are both conflicting economic indicators in the capital markets and conflicting coincident indicators in the labor markets that have divided analysts between the bull and bear camps. Currently, the yield curve, a leading economic indicator, is inverted, which has a nearly perfect track record at forecasting U.S. economic recessions going all the way back to the 1950s. However, the yield curve has remained inverted for over a year and a half, and a recession has not yet materialized, marking this economic cycle as the longest lag time between inversion and recession to date. While annual private economic growth and total economic growth weakened in the latter half of 2022, they have since recovered. Private economic growth weakens more severely than total economic growth during contractions, and this anomaly can serve as an early warning indicator of an impending recession. Yet the current private economic growth rate remains stronger than the total economic growth rate as of the first quarter of 2024, signaling further expansion instead of recession. The SOM rule, which is a coincident indicator for recessions, characterized by an increase of 0.5% in the unemployment rate from its cycle low, just triggered in May for the U3 unemployment rate, which is a narrow measure of unemployment. However, the SOM rule triggered in late 2023 for the U6 unemployment rate, which is a broader measure of unemployment, and yet the job market continues to grow at a stable rate, indicating the economy is still expanding and not contracting. Even the jobs in the goods-producing sectors of the economy, which include construction, manufacturing, and mining, and are more sensitive to economic swings in the business cycle, are continuing to expand. Job losses tend to increase before the SOM rule is triggered, leading to an economic recession, and this is especially true for the goods-producing job sectors because those sectors suffer the most during economic downturns. In addition, total private loans and loan interest rates have reached levels that forewarned of rising default rates in the credit markets, but the annual percentage change in loan delinquencies and charge-off rates have not risen to levels that warn of a total collapse in economic growth yet. Rising loan delinquency and defaults tend to precede job losses during economic downturns in the market, as they provide more of a glimpse into the stability of the capital structure of the economy that employs the labor to produce goods. This leads us to the equity markets. After the record run-up of corporate equity values by nearly 50% from its peak in 2019 to the previous peak in 2021, corporate equities collapsed by nearly 25% from rising interest rates, which is indicative of an economic recession, but they have since staged a surprising recovery with current values exceeding the previous peak by 5%. And this hallmarks the beginning of possibly a new bull market. However, not all is as they seem. The aggregate corporate price-earnings ratio in the entire economy has risen to 26, which is significantly elevated above the historically balanced P/E ratio of 15. This is signifying that a bubble is forming in corporate equity and the stock market at large, though this may temporarily reinforce the bull market narrative in the investor community. When we compare the different stock indices to each other, cracks start to materialize in the bull market narrative that betray an underlying weakness in the economy and help explain why current negative economic indicators have produced a false positive. The first piece of the puzzle shows up in the S&P 500 and the Dow Jones. The S&P 500 is a weighted index of the 500 largest companies in the U.S. stock exchange, while the Dow Jones Industrial Average comprises of 30 prominent companies on the stock exchange. From 2021 to 2023, the S&P 500 and the Dow Jones correlated very strongly with one another, and this is pretty typical of the two indices. However, starting in 2024, the S&P 500 started to strongly outperform the Dow Jones, growing as much as 19% from its previous peak in late 2021, compared with the Dow Jones' more modest 8% growth. Another piece reveals itself in the performance of the Russell 2000, which comprises of the smaller 2,000 small-cap stocks. While large-cap stocks indices are showing positive growth, the Russell 2000 has been in a bear market for nearly 3 years, contracting 17% from its peak in late 2001 compared to the S&P 500's 19% growth in the same time frame, though some of these losses have since been recovered in 2024. However, as strong as the S&P 500 has performed compared to the Dow Jones and the Russell 2000, it was outperformed by one other stock index, and that is the NASDAQ 100. Compared to the S&P 500's 19% growth over the last 2.5 years, the NASDAQ has risen by 25%. And this clues us in that the growth in the stock market is coming from technology-based companies. While the S&P 500 has grown by 34% in the last 14 months, its technology sector, which comprises over 30% of the S&P 500, has grown by 85%. As a matter of fact, only 7 companies listed in both the S&P 500 and NASDAQ 100 indices are responsible for the vast majority of this current performance. These stocks are known collectively as the Magnificent Seven, which are Amazon, Apple, Google, Meta, Microsoft, Nvidia, and Tesla. And these 7 companies are responsible for 70% of the growth in the S&P 500 and 60% of the growth in the NASDAQ 100. So in the end, what we see is an economic environment where the largest companies in a specific sector of the economy are thriving, while other sectors are stagnating, and in cases with smaller companies outright failing, which is stifling economic growth into virtual stagnation. This imbalance has caused a huge amount of capital to pile into the very top companies of the U.S. stock market, to the point where they are in a bubble evidenced by the performance of their earnings compared to their price. At this point, it's difficult to tell whether we are seeing further development of this bubble forming in the tech-heavy sector of the stock market, or if we are approaching the bust leading to recession. Aggregate economic indicators, such as the gross private product, private job growth, and specifically in the goods-producing job growth, suggest that we are not headed toward bust, while more specific indicators, such as the yield curve and the SOM rule in the labor markets, suggest that we are.